first paycheck. I was pretty excited, I'll be honest. I worked for weeks and weeks, and there in the sealed envelope was my very first hard-earned compensation, and I had so many plans about what I was going to do with the money. But those hopes were brutally dashed the moment I read the bottom line. And by the time the money actually got to me, it had been sliced up like a pizza. An alphabet soup of government agencies each got their cut before I did. But what are taxes anyway? How do they work, and how did we end up with this present system? First things first, the basic idea of taxation is pretty simple. There's some sort of state or similar authority that imposes a levy on an individual or a legal entity, like a corporation or something. If you can't pay, then you can be charged with a crime. This is a very old concept. It dates back as far as Mesopotamia and Egypt's Old Kingdom. Nowadays, the tax man's not going to beat the crap out of you for being late, but the system is way, way more complicated. In the United States, the taxes you pay vary from person to person, from company to company, from check to check, and then from state to state. However, most people do have to pay the federal income tax. And the U.S. tax system is huge, complex, doesn't even begin to describe it. A better word would be Byzantine, which I looked up earlier. In 1913, Congress passed the 16th Amendment, and the 16th Amendment says this specifically: the Congress shall have power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. Okay, let's be honest. While most folks in the U.S. only think about taxes when April approaches, the process really begins when you start a new job. You and your employer agree on your compensation or before tax income. Next thing you do is fill out a form called a W-4, and it determines how much income tax your employer will withhold from each check. Why do they do this? Good question. Employers are required by law to withhold income tax and deposit the money in a Federal Reserve Bank. And this is how the federal government maintains a steady stream of income, also drawing interest on your tax dollars. Pretty clever, huh? So instead of paying taxes once a year in April, you're actually paying them all year long, every time you get a paycheck. Now, the rules change when you're a freelancer or an independent contractor or you're otherwise self-employed. Nobody's going to withhold income taxes each time you get paid by a client or a customer, so it's up to you to manage what you owe. That's a good way to think of income taxes. Let's think of filing income taxes in April, kind of like settling up with the IRS. All you're doing is figuring out if you paid the right amount of cash. If you paid too much, boom, you get a refund. If you pay too little, boom, you're just writing another check. Income tax forms like the 1040 are notoriously confusing, but that's because they're based on a code that's more than 5,000 pages long, because somebody thought that would be a good idea. Presidential candidates are always talking about revising the system. But how, right? Well, there are all sorts of potential alternatives, like, for example, this thing called the flat tax. Under a flat tax system, everybody pays the same rate. So proponents of a flat tax system say that it would do away with all the complicated codes and forms. Critics say this system favors the wealthy, and that's not the most controversial idea. There's another one. It's even more controversial than the flat tax, the idea that we should just repeal the 16th Amendment altogether, abolish income tax, don't worry about it. In place of income tax, then, they would have a national sales tax. So many countries around the world already levy a national sales tax. You've heard of it before. It's called a value-added tax, or VAT. The difference is that most of these countries also collect income tax. U.S. backers of this plan want to get rid of the IRS and charge a flat 10 to 25% on all retail purchases of new goods and services. So people who are fans of this say that a consumption tax collects revenue from everybody, even illegal residents, tax dodgers, tourists from other countries, etc. Opponents say that it puts an unfair burden on the middle and lower classes who buy a lot of the stuff that will be taxed. They also say it might reduce consumer spending, slowing the economy down. And then they add that in order for it to be fair, it would have to be applied to the purchase of stocks and bonds in addition to consumer goods. Yeah, so it's no secret that taxes are a bitter subject in many countries. And the United States has had a, at best, a rocky relationship with this issue. The U.S. doesn't just have one of the most complicated tax systems in the world, it also grows more complicated each year. This is a politically charged, divisive issue, but there is one thing that everyone can agree on. The current system is not perfect. So here's a question. What would you change if you were in charge? Let us know in the comments. Go ahead and like and subscribe. Thank you so much for watching. We'll see you next time.
Okay, so just a little something to kind of get us to start thinking about income taxes as opposed to those Social Security and Medicare taxes. Income taxes that are withheld from employee paychecks go to fund the general services of the federal government. State income taxes then also go to fund the activities of the state governments. So this is what we're talking about in this particular chapter, not the Social Security taxes, but the income taxes that are withheld from employee paychecks in order to fund all of those services that many find superfluous, others find necessary. So I want to start today by reviewing, so we're going to go through some calculations today and start kind of getting into, sorry, I'm making you dizzy here. We're going to talk about that W-4 form that was mentioned in the video. We're going to go through that step by step because that's a really important form. And you're going to become familiar with it with regard to your homework and assignments. And then we're going to go through as well and talk about a couple of methods that are used for calculating income tax withholding. And we're going to go through those specifically and in detail. First thing I want to do though is kind of review, I'm sorry, I'm going the opposite direction. I have these agendas up backwards. Let me get these up. So we talked about on last Thursday a little bit of who is covered under federal income tax withholding laws. And by who is covered, what I mean is who is considered to be an employee and therefore is required to have income taxes withheld when they receive a payment. We talked about the definition is pretty much the same as what we used under FICA. So independent contractors would not be included in that, as it was mentioned also in the video. We're talking mainly about employees, those individuals who are classified as employees, both under FICA and under the federal income tax laws. We also talked a little bit about those statutory non-employees, who I said are kind of in this no man's land between independent contractor and employee. And then we also talked about, so that covered, who is required to have income taxes withheld at the source. And then we also discussed what type of income is considered income that requires federal income tax withholding with regard to how it relates to payroll. Now, there are other types of income aside from payroll that also may require or have as an option income tax withholding. Interest income, dividend income, those types of payments may also be subject to income tax withholding, but for our purposes, because we're focusing on payroll, we're really just interested in those employees and what types of income the employee receives that would be subject to income tax withholding. So again, pretty much the same definition as we went through with Social Security and Medicare tax under FICA, wages and salaries, vacation, bonuses, commissions, tips, again, And but we also talked as well about certain types of taxable fringe benefits that the value of which has to be added to the salary before we calculate income taxes. So these are items that where the employee does not receive cash, but they receive some sort of benefit from the employer that then is subject to income tax withholding. I think we looked at an example in the slides that had like a country club membership, and that value then is added to the employee's pay before taxes are calculated. There are two ways to do that, if you recall. We can tax it at a flat rate of 22%, like if we are assessing the entire value in one chunk. So a flat 22%, which is our supplemental tax rate, which we'll get into a little bit later as well, but that 22% is going to come back again. Or we can add it to our regular wages, and then that is taxed at our regular rates. Okay, so you can split that up over multiple paychecks. Certain travel expenses may or may not be included as a taxable fringe benefit. Reimbursements would not be taxable if they're part of an accountable plan, but they would be considered a taxable income if they are not part of an accountable plan, or otherwise known as a non-accountable plan. And then we ended up on last Thursday looking at this chart. The difference between employer-provided fringe benefits and employee-paid fringe benefits. These are items, these are non-cash items. On the left here, these are items that the employer is paying for on behalf of the employee, and they are subdivided into two different categories. Non-exempt, which would mean they're taxable. The value of that item is taxable. And exempt, which would mean that the value of that item is not taxable. So examples of these taxable item would be gym memberships, and I think that was one of our examples on last Thursday as well. The value of a gym membership then being added to the taxable wages before taxes are calculated would be an example of a non-exempt employer-provided fringe benefit. Employer is still paying for that gym membership, but the employee is going to pay tax on the value of that gym membership. Same as if the employer said, hey, here's $50, go get yourself a membership. That $50 would be included as taxable income. Well, instead, the employer is just directly paying for that, but the value of it is still being included in taxable. Non-taxable fringe benefits, good example of this would be health insurance. So if an employer helps to pay for an employee's health insurance premium, maybe all or part of it, as long as they are part of what we call a cafeteria plan, so there are certain requirements for it to be non-taxable, but the value of that health insurance premium then is not added to the employee's taxable income. So again, everything here on the left, the employer is paying for it. Over here on the right are employee paid fringe benefits. So these are our deductions, the amounts that an employee has deducted from their paycheck. And again, they are divided into two categories, post-tax and pre-tax. So if the employee is paying for it, the amount is still going to be subtracted from their paycheck. And then those funds are going to be redirected toward whatever it is that they're paying for. But some of those items are not going to be are going to be subtracted after we calculate the tax, so there's no tax benefit to the employee paying for them. Some of them are going to be subtracted before we calculate the tax, meaning that the employee is going to have a tax benefit. Their taxes are going to go down as a result. A couple of examples of these. So post-tax employee paid fringe benefit, and fringe benefit here is, well, so an employee paid fringe benefit may be most disability, or I should say, I won't use disability insurance because that's a bit of a complicated example. life insurance. So if the employer offers the employee the chance to purchase life insurance, that life insurance would be, the premium would be subtracted from the employee's pay, but it would be subtracted on a post-tax basis. The employee's not going to receive any tax benefit from the payment of that life insurance. The benefit to the employee may be that the tax or the premium rate is lower because you're part of a group plan, and just the convenience of it as well. It's automatically taken out and it's automatically paid, so they don't have to remember to do it on their own. Pre-tax type of fringe benefit, again, these are subtracted from the employee pay before calculating any withholding. 401k contributions that the employee makes. So we're not talking here about that. Actually, the 401k contributions that the employer makes would be considered a non-taxable, exempt type of fringe benefit. 401k contributions or retirement contributions that the employee makes would be pre-tax for federal income tax purposes for the employee. So if the employee, and oftentimes what happens with 401ks, I use that term, I'm assuming you're all familiar with that term, 401k. It just refers to a type of retirement plan that, and the 401k part is referencing the income tax code that that defines that type of plan. So, but there are different types of retirement plans. So with a 401k, usually there's an amount that the employee pays, and an amount that the employer pays. Usually there's some sort of match that the employer is going to contribute some and the employee is going to contribute some. And usually it's based on a percentage of income. So the employee's portion that they contribute to a retirement plan is pre-tax fringe benefit for them that they're contributing, and then for the employer, the amount that they're contributing is a non-taxable or exempt payment on behalf of the employee. So there's a double benefit there for the employee, right? They're not going to pay, they're going to reduce their current taxes by contributing to the 401k, and they're essentially getting free money from the employer who is contributing an amount to the retirement plan on their behalf, and that amount is then not being added to their taxable pay. Okay. All right, there is a list in here. Oh, I think we already went through that. Travel. Did we cover the tips? So the employees, for income tax on tips, I know I'm kind of jumping around there between those examples. I just wanted to review what we talked about on Thursday, and then get started with some new stuff. So employees who receive tips have to report those tips to the employer by the 10th of the month following the month of receipt. So this month is October. Any tips received have to be reported then to the employer by the 10th of November. The employer then adds the value of those tips to their calculation of withholding. By the way, you've got at least one homework problem that involves an employee who is receiving tips and doing the calculation of that federal income tax withholding involving tips. Also, the employer will collect income tax and they'll withhold Social Security tax on reported tips. Now, there's another way that employers can do this without actually having the employee report the actual tips on a monthly basis, and it's called tip allocation, where the employer will, based on, could be the amount of sales that the employee had during the previous month, could be based on some other factor, they estimate what those tips are. If the tips are allocated, then the employer does not have to withhold on allocated tips. They only withhold on the actual amount of tips that are reported by the employee. Again, so there are 3 methods for allocating tips. You can base it on hours worked, gross receipts, or some other agreement between the employer and the employee. And again, this is more a method of like estimating what the tips should have been approximately. So the employee doesn't have to actually record how much they received in those tips. We already talked about this accountable plan versus a non-accountable plan, so I'm not going to go through that again. So this is just a list of some of those exempt payments. So if recall the table there, exempt payments would be amounts that the employer, where am I here? I'm thinking and talking at the same time. Sometimes that doesn't work. So amounts that the employer paid on behalf of the employee, but they are not subject to, the amount's not going to be added to the taxable wages of the individual. Your book has all of this. A couple of them that I wanted to point out. Let's see. Oh, not really any of those. Let's see, where was it? Educational assistance, this is one. So if the education, so an employer can pay on behalf of the employee up to $5,250 a year for tuition on behalf of the employee. Any amount over and above that then becomes taxable benefit to the employee. But up to $5,250 of tuition assistance can be paid on behalf of the employee, and it will not be added then to the employee's taxable wages. That's a great benefit. Normally what would happen if the employee is paying for their own tuition, they may be eligible for a tax credit for that, the American Opportunity Credit or Lifetime Learning Credit, but it's not going to be at 100%. This is 100%. The employer pays it on your behalf, and the employee doesn't pay any tax on it. So again, free money. We already talked about those employee business expense reimbursements and the difference between the accountable plans and non-accountable plans. Employer provided parking. So oftentimes, especially if you're living in a city, you've got employees will have to pay for parking spaces when they commute down to the office. Up to $300 a month can be reimbursed to the employee, and none of that is considered to be taxable income to the employee. Let's see. A couple of the other ones here. This group term life insurance. So the employer can pay the premium on life insurance for the employee as long as the benefit is $50,000 or less than $50,000. So if the employee passes away, whoever their beneficiary is that they choose receives less than $50,000. If that is the case, then none of the value of the premium that was paid is considered taxable income to the employee. However, once the benefit is more than $50,000, then the amount of the premium attributable to that additional benefit would be considered taxable income to the employee. Okay, $50,000 is probably kind of low. That has not changed for quite some time, so it hasn't really kept up with salaries. Oftentimes employers will provide life insurance to employees based on the amount of their salary, so like 1 times their annual salary or 2 times their annual salary. So oftentimes that benefit is going to be higher than $50,000, which means the employer has to determine how much of that premium is attributable to a potential benefit of more than $50,000. What else? Which ones do I want to mention here? So I already talked about retirement and pension plans. Any amounts that the employer provides, the employer pays on the employee's behalf, are not taxable to the employee. So let's say you make $100,000 a year and the employer is going to pay 5% of your salary into a retirement plan. Well, it's $5,000 a year that's going into a retirement plan that the employee does not have to pay tax on. Now, ultimately, hopefully if it grows in value, and then at the point that they take a distribution on that plan, that's when the employee will pay taxes at the time that they take the distribution. But for most people, when they get to retirement age, they're probably paying tax at a lower tax rate because their income has gone down in that time. So, but that's a great benefit for employees. What else? Oh, so just like with the parking, transportation, so if the employer pays for, again, a lot of times in urban areas, maybe for light rail pass, a monthly light rail pass, or bus pass, or that sort of thing, up to $300 a month is not taxable to the employee. So these are all, and of course this is not an exclusive list, but example of types of payments to employees that would not be taxable to the employee. So these types of benefits for them. So I mentioned cafeteria plan earlier. Cafeteria plans are specific types of plans that involve usually health and well-being types of benefits. And they have an administrator of these plans, and even small businesses can sign up for them. What it does is it protects the benefits within this plan. It makes them non-taxable to the employee. So some examples of types of benefits that can be included in these: health and accident insurance, so health insurance essentially. Self-insured medical reimbursement plan, that's where the employer, instead of having insurance, they reimburse for medical expenses, so they don't go through the hassle of actually having to have a contract for medical insurance. That group term life insurance is part of the cafeteria plan. Dependent care assistance. Some of you may be familiar with this type of benefit, whereby employees can, and dependent care assistance is paid by the employee. So it is a pre-tax benefit, or a pre-tax fringe benefit that the employee pays for, not the employer. What the employee does is they direct the employer to deduct a certain amount from each paycheck that is then diverted into like a savings account. And when the employee incurs expenses for dependent care, usually child care and that, but it doesn't have to be exclusively for child care, but when the employee incurs expenses for that, they draw from that savings account. Okay. They essentially get reimbursed, but then it's coming from a savings account that with pre-tax dollars. And then there are health savings accounts that work similarly. So the employee is saving for health expenses, that those funds are being diverted into a savings account. Then they can draw upon that savings account when they incur those health savings expenses. All right. Questions up to now? I know that's a lot of words. Keeping that sort of table in mind with the employer paid benefits and the employee paid benefits, and the difference between taxable benefits, non-taxable benefits, pre-tax benefits, post-tax benefits. All right. So now, what we want to focus on, so those were mostly, except for the cafeteria plans, those were mostly employer-provided benefits that we were talking about, or employer-paid benefits that we were talking about. Now we're going to switch over to employee-paid benefits. So these are the pre-tax salary reductions. That means that their salary is going to be reduced. Pre-tax means we're going to subtract that before the value of that benefit before we calculate the tax. So there's gonna be a tax savings involved for the employee. Contributions to cafeteria plans. So if the employee makes contributions to any of those cafeteria plan type benefits, those would be pre-tax. So they're gonna be subtracted from the employee's pay before we calculate the tax. So at a very simple level, this is what it looks like. Let's say we have a salary of $1,000. And then we have a pre-tax benefit of $200. This is the amount that's taxable. If we didn't have that $200 pre-tax benefit, the amount that would be taxable is this $1,000. So from a very simple standpoint, let's say we're using that 22% rate, we would owe $220 if we didn't have that deduction. For the 800, what is 22%? 216 plus 16, is that 176? I think it's 176. 22% of 800. $176. So you can see how it reduces the amount of tax that is being withheld from the paycheck, those pre-tax types of benefits. What are they talking about here? This is, again, they're just describing here another type of pre-tax salary reduction, and this one pertains to medical expenses. These are often called FSAs, flex savings accounts. Employees can put up to $3,050 a year. That's for 2023. I think it's $3,200 a year in 2024 into a flex savings account, and then they can use those funds to pay for medical expenses. I have one. It's paid for my kids' orthodontia the last few years, and you want to manage it from year to year, because if you leave any money in there, it has to be used during the year. This flex plan has to be used up. Otherwise, what happens is the employer gets the amount that's remaining. So if you have $3,000 withheld and it's sitting there and you don't use it, you've just given up $3,000, and the employer is going to get that amount. There's another type of medical savings plan called a health savings account, where the limits are different and you don't lose the money if you don't use it. So, but it has to be paired with a particular type of health insurance. So that's a separate, kind of a separate type of benefit. But this, again, this is called a flex savings account here. Does anybody have any experience with flex savings accounts through employer?
I had it for a year.
Yeah.
I got rid of it.
Got rid of it?
I never used it.
Because you didn't use it.
I forfeited $500. I immediately got rid of it.
Yeah, you kind of have to do a calculation to make sure that you're gonna spend the money.
I banked off of what had happened the previous year.
Right.
And then I had nothing medical happen that year.
Right, exactly. Now, there are like if you wear your glasses, you can purchase glasses with them. A lot of people, and you'll see these at the end of the year if you go into Walgreens or CVS or someplace, you'll see these signs about, hey, spend your flex savings account money, because they know that people will have these funds in their accounts that they need to spend down. So a lot of times people, and I mean, like I said, they're pretty flexible. I mean, you could, like a chiropractic care and stuff like that, or other medical tests or things like that, you can spend the money on. Even some like medical devices, even if it's like your choice, as long as you have a prescription for it, you can spend that money down. Otherwise, like you said, Anthony, you just lose it. The HSA, like I said, is a little bit different. It is also a health savings account, so it's for medical expenses. You don't lose it, but like I said, it has to be paired with a particular type of health insurance. called a high deductible plan, and not everybody has that type of health insurance. So this is a great benefit if you know you're going to use it. Like I said, with the orthodontia, I knew I was going to use it. I didn't have enough in order to pay for all of that. But you do have to plan for it and make sure. I mean, if you're somebody who regularly has a lot of medical expenses, it's probably a great idea because it's going to lower your taxes.
It'd be great now. My daughter, her glasses, she has to get new ones like every 4 to 5 months.
Mhm.
She's blind as a bat.
Yep, exactly. Not every employer offers these, obviously, but it's one of those benefits that employers can offer. It doesn't really cost them anything other than the administrative costs of doing it. So the health savings accounts, I mentioned those as opposed to the flex savings accounts. Health savings accounts, you have to have a high deductible health insurance plan. HDHP is what they're called, high deductible health plan. High deductible for, and they've got the 2024 amounts here. Means if you're an individual, $1,600 or more for the deductible, $3,200 or more, and that's referring to the amount of the deductible for the health insurance. The amount that you can actually contribute is about $7,000 to $8,000. So it's a much higher amount that you can contribute, but you don't lose it. It's yours forever. Even if you stop having that high deductible health plan, you get a different type of insurance, you still can keep the HSA funds, okay? All right. Retirement contributions. So again, with retirement, we've got kind of two parts to it. We've got the, oh, I erased it. So we've got the employer's portion and the employee's portion. So if the employer is contributing 2%, that amount would be, oh, it's not very much, is it? $20. And the employee is contributing 2%, that's also $20. This amount is not going to be added to the salary because it is a non-taxable fringe benefit. So it's not going to be added, but it's an amount. So in total, the employee is getting $40 added to their retirement fund, 20 from the employer, and it's not going to be subject to tax, to income tax. And then they are contributing as well $20, part of that 40, and that is going to reduce their taxable income. So there are two portions, oftentimes there are two portions to that, not always. So it can be, there can be a situation where only the employer contributes or only the employee contributes. That is possible as well. Oftentimes though, what you'll see is that both are contributing. And for the employee, it's going, the amount the employee contributes, it's going to reduce their taxable income, and the amount that the employer contributes is not going to increase the employee's taxable income. So they're getting essentially, I mean, they've got to pay the $20, they're getting $20 extra from their employer, and it is not being taxed currently. There are different types of retirement plans. Like I said, I used the example of the 401k, but some of them, one is called an IRA, individual retirement account. Individual retirement accounts, only the worker, the employee contributes. There are certain income limits for the IRAs. Roth IRAs are a different type of retirement account. Again, it's an IRA, so it is only contributed, only the employee contributes to it, but a Roth is kind of different in that it's not pre-tax, so you don't get this deduction for any amounts that you contribute. However, when you retire, none of the amounts that are withdrawn are taxable, right? They're great. Roth IRAs are especially great for younger people. You can accumulate a lot. When you're younger, you tend to be in a lower tax bracket, so maybe the tax deduction isn't as beneficial. And so if you contribute after taxes, it's not really gonna affect your taxes all that much, but ultimately it's gonna grow for years and years and years. And at the end, you could have a pretty nice nest egg, and you can withdraw any amount of it for tax-free. So that's the benefit of the Roth IRAs, just a different type of retirement fund. Does anybody have experience with Roths or traditional IRA?
I had a TSP.
Oh yeah, the federal government has their own. They've got their own everything. The federal government.
It was great when I withdrew it because I forgot about it. Like, I put in 5% when I was working for the post office,
Mm-hmm.
but while I was in the military, I also had a TSP and I put in 25% because I didn't need the money while I was overseas.
Right.
So when I withdrew, when I quit the post office,
You had
it
a
was
little nest.
$45,000.
Yeah, you had a little nest egg there that you had and probably didn't really even notice the difference when you. Yep.
Benefits are great if you are willing to be stressed out and want to walk out in traffic.
All right. Okay, so that kind of, one other thing that I wanted to mention about the retirement benefits that is different than other types of benefits. They are pre-tax for the amount that the employee contributes is pre-tax for income tax purposes, federal income tax purposes. It is not pre-tax for Social Security and Medicare tax purposes. And let me show you an example of how that would work. So if you've got this salary, I'm going to forget about the employer portion here, just for a second. You have to do two calculations then if you've got retirement contributions. So salary of $1,000 and you've got retirement is 10%. So for federal income taxes, and you're going to see this in your homework, you'll see this abbreviation FIT, federal income taxes. If it says CIT, that's city income taxes, SIT, state income taxes. Okay, so for federal income tax purposes and for FICA purposes, we have to do two calculations. That retirement of 10% is going to be pre-tax for federal income tax purposes, so our taxable amount is $900. It is not pre-tax for FICA tax purposes. So our taxable amount for FICA is $1,000. So when you're doing the calculation for FICA, you got to base it on this. When you're doing the calculation for federal income taxes, you have to base it on this.
Is there anything that's pre-tax for FICA?
Yes, almost everything else is. Like all of those other contributions, those pre-tax contributions, the FSAs, the HSAs, all of that, health insurance premiums as well. The retirement is one of the few things that is pre-tax for federal income tax purposes, but not for FICA purposes. But almost everything else is pre-tax for both, okay? So if it was health insurance, so let's just say we've got health insurance that we're contributing, $200. We would also subtract the 200. Then when we're doing our calculation, we're gonna base our withholding, our income tax withholding on the 700, but our FICA withholding on the 800. Okay, so like I said, you gotta do two different calculations for both of those. But it's only, and I don't think there's any other in your homework and in your book, I don't think they talk really about any other items that are different between the two, but that is a big one. And I know you've got some problems that involve those two separating out those calculations. All right, let's take a look at the W-4 form. Let's get this up here. All right, a lot of you are probably familiar with the W-4. This form went through a lot of changes between 2019 and 2020, it changed. And you'll see the supplement, the very last thing that we're going to discuss in this chapter is how we calculated withholding before 2020. most of our time is dedicated to calculating withholding from 2020 until now. We still need to look at the old way of doing it, however, because how it's withheld is based on which W-4 form the employee has used. Most employees will have the newer form, but there's still employees out there that use the old form. They filled it out before and they never filled out a new one. So we've got to still do some calculations based on that old way. But like I said, for our purposes, most of our time is going to be spent on this new method of the new W-4 form. So the first part of the form, again, just identifying information, name, first name, last name, social security number over here, and then filing status. Filing status is determined by the employee. So this is one of those areas that sometimes payroll professionals will get questions from employees who are new hires. They'll ask them, well, how do I fill this out? What should I do? What filing status should I be? You can't answer that question for them. That's tax advice. So the advice to always give them is you need to ask your tax advisor. A lot of them won't have a tax advisor, but you can't give them the answer. You can't, like the payroll professional doesn't know what their filing status is.
I file this way.
Yes.
That is the only advice I ever get. How do I fill this out? I was like, this is how I file, otherwise I don't know what you should do.
Right. Yes, exactly. So so you can't, you've got to direct them somewhere else because like I said, otherwise you're giving them tax advice, and tax advice is legal advice. And if you're not a CPA or an attorney or an enrolled agent, you can't give that advice. Did you have a?
Oh, I was just gonna say, I just got recently hired at a CPA firm,
Mm-hmm.
and I filled it out, and I guess I filled it out a little wonky.
Mhm.
Not quite wonky, but because I'm used to all my jobs before this were paid weekly, this one paid monthly.
Mm-hmm.
So I'm not used to filing for a monthly job, and I
Right.
took it to my boss, who is a CPA, and he was like, "This looks a little wrong. Let me change this for you."
Oh, well, and in that case, he is a CPA,
Yeah.
so he can give you some advice there. But yeah,
What if my payroll person is a tax person?
right, exactly. So so filing status. Generally speaking, and that filing status part can change, right? So you can see that there's actually 5 filing statuses, 3 boxes though, because for 2 of these boxes, 2 of the filing statuses share a box. So single or married filing separately. Single is just that, single. You're not married. That is determined as of the end of the year, by the way, on December 31st. So if you were married on December 30th and you got divorced on December 31st, you are single for the whole year. Married filing separately, that's where you are married, but you're choosing to file your tax return as 2 separate returns. Most times that is disadvantageous from a tax standpoint. However, people have their reasons for wanting to do it, even if it does end up costing them more. Maybe you don't trust your spouse, and when you sign a tax return, you are signing under penalty of perjury, and you're attesting to all of the information on that tax return, even if it's combined with your spouse's information. So you're attesting to their information too. So if there's some issue there that you think, I don't really know that I want to sign a tax return with my spouse, then somebody might choose to file separately. I had clients that filed separately for purposes of, like, they had student loan debt, a lot of student loan debt, and they wanted to take advantage of some of the repayment schedules, to reduce their repayment amount every month. But when they combined their combined income was too high to qualify. When they separated their income, each of them qualified. So even though they paid a little bit more in taxes, it saved them money with regard to repayment of their student loans. So anyway, so that particular filing status, it's less common than married filing jointly, because married filing separately is usually means it's going to cost you more in taxes to do it that way. Next box here, married filing jointly or qualifying surviving spouse. Married filing jointly, again, is just that you are married, and you are choosing to file together on one tax return. The tax brackets and rates are a little bit, well, the brackets are different depending upon filing status. So like the married filing separately, the brackets are less, what do I want to say, less generous. So it's the tax rates increase a lot more quickly with these single or married filing separately than they do for married filing jointly or qualifying surviving spouse. Qualifying surviving spouse is an individual who is a widow or widower and they have a dependent. Individual is qualified to file in that status for 2 years, up to 2 years after the death of their spouse, unless they get remarried. And then they'd be probably married filing jointly anyway. And then head of household, this is where it's a single individual with a dependent. So, and there are a lot of other factors that go into determining head of household, but these filing statuses, when I'm teaching income tax, I will tell students when we're going through this, you think this is like one of the first questions on the tax return, and it's one of the first questions here. It is one of the most difficult questions. It can be one of the most difficult questions to answer because there's so many nuances and little details that go along with determining the proper filing status. So that as well is a reason not to answer that question for people because it can take a lot of research to determine what somebody's filing status is. And filing status can change during the year. So they start out the year as single and then they get married. Well, remember, it's as of the last day of the year what your filing status is. So if somebody gets married during the year, they're going to want to change this as soon as possible because it's going to change how much is being withheld from their paycheck. Or they get divorced during the year or their spouse passes away. They're going to want to change what is on their W-4 form. So different circumstances in people's personal lives will cause them to want to change this W-4 form. Anytime somebody wants to change the W-4 form, if they had the old form, they have to go to the new form, this new form. So if they had the 2019 and earlier form and they get married and they want to come in and fill out a new W-4, they cannot fill out the 2020 or earlier form. They have to fill out this new 2020 or later form. All right, so I've only got to the first part of this. That's step 1. Step 2, you're going to be using this checkbox here is going to become important in your homework and in your calculations. So complete this step if you hold more than one job at a time or are married filing jointly and your spouse also works, so 2 incomes. So if it's just one of you, only one income, you don't have to fill this part out. However, if there is more than one income, then you need to fill this out. Now, there are a couple of different things that one can do. And this is to calculate what the withholding should be based on both incomes. So you can get pretty precise with the withholding if you want to go into a lot of detail. This multiple jobs worksheet is on the second page of this form. Let's see, or not the second page, I guess it's the third page. So this is a form that can be filled out to actually calculate how much to withhold. So actually give the employer a number of how much to withhold. I'm not going to go through all the details of that. Just know that it's there. The other way is the easy way of doing this. If there are 2 jobs in total, if there are only 2 jobs in total, you may check this box. So you and your spouse have a job or you have 2 jobs. Do the same for the form W-4 for the other job. This option is more accurate than the second option if the pay at the lower paying job is more than half of the pay at the higher paying job. What does that mean? So if you've got one job where you're paid $50,000, second job where you're paid $30,000, that is more than half of what you're paid at the first job, then it's more accurate just to check this box. Okay, and then the calculation of withholding is baked into the tables that we're gonna look at in just a little bit, okay? Your homework tells you whether or not this box is checked or not. It's called checkbox withholding. The other, if it's not checked, it's called standard withholding, okay? You're gonna wanna know that terminology because that's what's in the problems. It'll tell you it's standard withholding, and then it'll give you, I can't do that, it'll give you the filing status, how much of the income is taxable, and then the frequency of pay. So this, for your purposes right now, this is the most important part. We're not gonna use that multiple jobs worksheet. We're just gonna say whether or not this box C is checked. So is the box checked or not? Yes or no? Step 3. This is for dependents and other types of credits. So it mainly is focused on 2 types of credits. One is the child tax credit and one is the credit for other dependents. Child tax credit is for eligible children who are your dependent, who are under the age of 17 by the end of the year, at the end of the year. If they turn 17, why 17 and not 18? I have no idea, probably to save money. But if they are under age 17 by the end of the year and they're your qualifying dependent for purposes of the child tax credit, again, that's a question you really can't answer for people, right? No idea, you know, it's a very involved question. You would enter the number of qualifying children under age 17 and multiply it by 2,000. So if you've got 2 kids that are under age 17 and they are your qualifying dependent, you'd enter $4,000 there. Got 3, $6,000. 1, $2,000. None, don't enter anything, right? There is this other credit called the credit for other dependents, and that is for individuals who are your dependent, but they don't qualify for the child tax credit. So maybe they turned 17 this year. They no longer qualify for that $2,000, but they do qualify you for $500 credit. Then you would multiply the number of other dependents by 500 to enter that here. You could have both of these entered. Maybe you have multiple, maybe you've got 2 kids that are 18 and 17 and one that's 4, then you'd have 2,000 up here and 1,000 down here if they were qualifying. So it could be that they're both entered, maybe one or the other, maybe none, right? Then the employee adds these 2 together and that goes on line 3. Okay. Step 4, or any questions so far about the different stuff on here? Step 4, other types of adjustment. Other income, not from jobs. So if you want to have, say you've got $3,000 of interest income and you never have any withholding on it and you always end up paying tax because you don't have anything withheld, you can include that on this form, and then the calculation for withholding will include that $3,000. So you can have more withheld to take into account other income if you want. Don't have to do that. So if you've got some other income where there isn't withholding, but you want to prepay the income taxes, you don't want to have to owe at the end of the year, you can include that in the calculation here, and then you'll have more withheld. Does that make sense? Okay. So you would add that there. Deductions. So this is other income. This is a deduction. So if you expect to claim deductions other than the standard deduction and want to reduce your withholding, there's another separate worksheet where you can calculate how much to enter here. This would then be a subtraction from the income we're using to base our withholding on. So that would be like itemized deductions. When you fill out your income tax form, you get a choice between taking a standard deduction, which is based on filing status, or you can itemize your deductions. Most people take the standard deduction because usually that's the larger amount. But individuals who itemize their deductions, usually they have mortgage interest, they have maybe high charitable contributions, maybe they have a lot of medical expenses that are deductible to them, or they pay a lot in income taxes or property taxes. Those are different types of itemized deductions. Like I said, most people, the standard deduction is more advantageous than itemized deductions. But if you do itemize your deductions and you want to calculate that in, you can then use this worksheet to determine how much further to reduce your taxable income on here. Again, this is all just estimating how much tax you're gonna owe for the year. And then when you fill out that 1040, it's a reconciliation. How much did you have withheld in total versus how much you owe, right? So, and then if you just want an additional amount of withholding, you know, maybe you're always just, I don't know, $500 short at the end of the year. You always end up paying, and you're tired of doing that. So you say, okay, well, you know what, I'm gonna have an additional $50 a paycheck taken out, so I don't have to worry about that anymore. You can do that. You can just put in a number here, okay? All of this information is then used by the payroll department to calculate what the employee's withholding is gonna be, okay? So bottom part of this is just the employee's signature, and again, so there's that word, under penalty of perjury. To the best of my knowledge, that this is true, accurate, true, correct, and complete. That's what's on your tax forms too, by the way. That's how they get people. Here's the deduction worksheet, and you can see it goes through. It's got the standard deductions listed here for the different filing statuses, so it can do the comparison for you whether it's worth it or not to fill that in or not. All right, questions about the W-4? No? I'm gonna close them. Okie doke. We've got a few minutes left here. Let me take you through. So we have two different withholding methods, two different ways to calculate this. You're gonna like the table method, you're not gonna like the percentage method. I shouldn't say that. If you like doing math, you're gonna like the percentage method. There's just more to that calculation. But there are certain instances where you have to use the percentage method and you cannot use the tables. And it has to do with how much income, how much taxable income the employee has during that period. But for either one of these methods, there are 4 items of information that you need, okay? Actually, there's at least 4, I should say. Okay, at least 4 pieces of information that you need in order to calculate income tax withholding in either of these methods. First one is taxable wages. By taxable wages, I do not mean gross wages. I mean the amount after all of those pre-tax deductions, after any taxable fringe benefits have been added. So this is after we've determined how much is actually going to be subject to income tax, right? So if we had 401k contributions, taxable wages, we've already subtracted it. If they have a gym membership that the employer is contributing to, then the value of that gym membership has been added already onto these taxable wages. So this is a subtotal, I guess is probably the right word. So again, after taxable fringe benefits have been added, after pre-tax deductions have been subtracted. That's the first item. Second thing we need to know is filing status. On that W-4, we had what box was checked there, right? Was it single? Was it married filing jointly? What was that filing status? Third thing we need to know, frequency of pay. Weekly, bi-weekly, semi-monthly, monthly, etc. How often is the employee paid? And then the fourth item that we need to know, and again, I said at least, at a minimum, because we may need to know about dependents as well. That information that was in step 3 and 4, we may need to know that information as well. But at a minimum, we need to know this. Checkbox. Yes or no? Was it checked? Yes or no? Those are the 4 pieces of information, the 4 minimum pieces of information that we need. All right, so how do we do this? Let's see here. I'm going to see if their example is. We already went through all that. Oh, I should mention to you. Okay, so they talk about exemption. So an employee can claim an exemption from withholding. There are certain circumstances under which they can claim that. That means that they won't have any income tax withholding. Okay. If they had no income tax liability last year, and I don't mean they got a refund, I mean they owed nothing for the entire year, right? So they had no income tax liability last year, and they expect to have no income tax liability this year. Most common time that this happens is if you've got like high school or college kids who are still your dependent, and they have a job, like a summer job or something like that, and they don't earn enough to make them to have that they owe taxes on that. Instead of going through the hassle of having income taxes withheld, and then they've got to file a tax return to get that money back, which means they probably have to pay somebody or go buy TurboTax or beg their parents to file the tax return for them. Instead of going through all that, they could just claim exempt, and they don't have anything withheld. They don't have to file the tax return. So it saves them some hassle and expense on the end. Most people don't get to file that status, but it is possible. Now they say employees cannot claim income tax withholding if they are dependent on someone else's return and their income exceeds $1,250, or unearned income is less than $400, but total income is greater than $13,850. So there are some that's when those students that, those dependent high schoolers, college students may not be able to file that, but that's the most common way that people file exempt is in those circumstances. Again, employee can request that the employer hold an additional amount, which I showed you on the form where that is. Let's see, I just want to see if there's anything else that. Oh, so the W-4 forms, the employer doesn't send them anywhere. Just like those I-9 forms, they're kept on file, but they have to be kept on file, right? And they do require a signature. There are penalties if you willfully and falsely file a form W-4. So if you say you're married filing jointly and you're really single, and you do it intentionally, there can be a penalty for doing that. So employees would be subject to fines up to $1,000 or imprisonment for up to a year or both. Or if they claim deductions, like they go through and they claim deductions for itemized deductions, but they know they're not going to itemize their deductions, they're going to take the standard deduction, that as well would be subject to a penalty. There are some special rules for non-resident aliens. There is usually a flat amount that has to be withheld from any payments to non-resident aliens. Okay. Let's see. And then this is just kind of a list of some other W-4 type forms. So there's a W-4 for pension or annuity payments that if you are receiving a pension, you would fill out a W-4, but it's a W-4P for that. Third-party sick pay, so that's like disability pay, has its own type of W-4 form. Government payments, Social Security benefits, when you're receiving Social Security benefits, you can fill out a W-4V. Social Security payments, you do not have to have income tax withheld from it, but some people do choose to do so because maybe they've got other income that is subject to income tax. All right. So we'll go back to starting to talk about the calculation of federal income tax withholding. 2 methods to calculate this. Wage bracket method, as I mentioned here, this is the easiest. This is the table. You simply gather this information, then you look at a table, okay, to determine how much withholding. Or the percentage method. Percentage method involves some calculations. So we would use the percentage method when income is high enough that it does not fall on the table. Because the tables are limited, right? They're only going to go up to a certain income level, but incomes can be infinite. So once they price out of the table, once an employee prices out of the table, we've got to use the percentage method. Okay. There are some other methods, we don't really use them. We're really just going to focus on these 2 methods. And again, so that kind of summarizes a lot of this stuff. How often pay? They say gross pay here. I don't like using this term because gross pay is we want taxable pay, right? We want to know how much is actually going to be taxable. And then if necessary, any information from those steps 2 through 4. I'm not going to use their example. Okay. So I want to show you in the module, your book, like I said, I think I said this on Thursday, your book has the tables, really hard to look at. They're like over to the side and they're about this big, the numbers. So in Canvas, I've got the tax tables listed. So you can download this form if you want, or this publication if you want. You can print it, do whatever you want with this. But it's a lot easier to look at. So, and I had mentioned this as well on Thursday that we're going to be using 5 different tables here in your homework. Most common ones that you're going to use: wage bracket method for 2020 or later, percentage method for 2020 or later. So there's those 2 methods I just talked about. This is the table one, and this is the one that involves calculation. I think you've got a problem or 2 that involves this percentage method tables for automated payroll systems. This one is where you have information on an annual basis of what the salary is. So you're going to use that annual salary to do the calculation. So this is somebody who's going to be getting paid the same amount every pay period. And then when we get to it, the appendix, and we start looking at the 2019 and earlier methods, we'll use the wage bracket method for 2019 and earlier and the percentage method for 2019 and earlier. They're very similar, but not exactly the same as what we're going to go through here for the 2020 and later. Okay, so let's look at wage bracket method. I'm going to skip over this for right now. I'm going to show you these tables. So this is for the wage bracket method. These are the tables. What you do is you take the taxable wages that you've calculated, and you find on the table, well, let me back up. I'm sorry. First off, you need to get the correct table. I wish they would put this in larger print, but this is for a weekly payroll period, this particular table. Scroll down. This is still for weekly, same table. Then we get to bi-weekly. Make sure you're on the right table, because the answer is going to be different if you're on the wrong table. Then we get down, scroll down a little bit further, bi-weekly, semi-monthly payroll period. And then you can guess what one comes next. It's the monthly payroll period. So again, make sure you've got the right table for the frequency of pay. This is why we need frequency of pay, so that you can choose the right table. All right, So let's just say we've got somebody who taxable wages are $1,200. Filing status is single. They're paid weekly. And they did not check the checkbox. All right. So we could go to our table. We need to find the weekly table, first off. Here we go, weekly payroll. Over on the left-hand side, you can see it says, if the adjusted wage amount, and this line 1H is referring to this form up here. This is to help determine this taxable wages. I'm just gonna start, I'm not gonna use that right now. I'm just gonna start with, we know what those taxable wages are. We will go through a little bit later how this form works, this worksheet. So, $1,200. If the adjusted wage amount is at least this amount, but less than this amount, then based on filing status, married, this would include qualifying surviving spouse, qualifying widow or widower, by the way. Head of household, single or married, filing separately. Standard withholding, checkbox withholding. So standard, remember, means the checkbox was not checked. All right, so over here, at least but less than. Notice that each of these income ranges, so we start with, let's do this 135. We've got 135 here and then we've got 135 here. What if it's exactly 135? Well, a little hint, you're always gonna use the line, the second line. Because if you look at the wording, at least but less than, $135 is at least $1, or at least $0, but it is not less than $135. $135 is at least $135, right? So always use the next line down. So in our case, $1,200. All right. Here, I want to show you too. So like this is the end of the weekly, and it ends at $1,925. So if the income was more than the taxable wages was more than $1,925, we couldn't use these tables. We'd have to use the next method that we're going to talk about on Thursday. So this is $1,200, so we're going to find the range for $1,200. All right, at least $1,195, but less than $1,205. That's our line. Now we're going to have to choose over here the correct number. So our individual, based on filing status, single. So we're going to use one of these two here. Checkbox not checked, so this is the column that we're going to use. Standard withholding. So for $1,200, standard withholding, $115. There's our federal income tax withholding for this pay period. Let's do a different one, real quick. Let's say we've got somebody like that. Taxable wages are $479. Filing status is married, filing jointly. Frequency of pay bi-weekly. Checkbox, yes. Change all of it up there. All right, first thing we're gonna do is find the correct table, bi-weekly. Bi-weekly here. Here's where bi-weekly starts. All right, next we need to look at that income range. So $479, well, this is gonna be an easy one. $479 is between $470 and $480. Okay, they are married, filing jointly. Checkbox is checked, 0. In this case. Make sense? Seems pretty easy, right? All right. I'm out of time. So we're gonna pick up, we'll do some more exercises like this on Thursday. And then we'll start looking at the percentage method and how that's calculated as well. Okay, that's even more, that's more fun.
That's the one we've been doing in business math.
Oh, have you been doing the percentage method in business math? Okay.
It's this much and then plus a percent of the overage of this.
Yep, yep.
I hate taxes.
Now you tell me.